Hey everyone, it's Daniel here from Infovest. Hope you're all doing well. Let's talk about retail sales. So retail sales came out stronger than expected. The core number and the headline number beating market expectation, coming in way better than expected, basically telling you that, hey, spending the economy is doing well. The consumers are going out and purchasing goods, services as usual. The economy looks good. And guess what? Retail sales is a big component to the GDP. So if retail sales is doing good, that tells us growth and GDP is also expected to do well because retail sales are doing well. We also had the Empire manufacturing numbers come out as well, which basically is a manufacturing data that suggests it's a number that comes before all of the ISM manufacturing, all the other manufacturing numbers that come in the first week of the month, which we're gonna get next month. And that number came in way better than expected, also hinting towards that, hey, everything's fine. Hey, we may be seeing a rebound. Although the number is still negative, the expected was negative 18. The number came in minus 5. However, that is still a big change and to the upside, and which suggests that, hey, the growth in the economy is doing well. So how did the markets react to this? What did the markets feel? Well, bonds sold off, stocks sold off. Bonds took its time to basically reverse, but the stock market quickly reversed, had a little bit of selling, and then reversed again and started to make new highs before 9:30 a.m. open. Now, the equity markets are taking this information, like I talked about before, taking this information differently than the bond market. The bond market is looking at this and saying, hey, this just means more rate hikes, as we've been showing through our selling, especially in the short end. And the equity markets are like, hey, even though the data is stronger, this still plays in with the soft landing narrative. This still plays in with the idea that, hey, the economy can and is look like it's withstanding the rate hikes. So it doesn't matter, brush it off, because good news is good news, right? Good news means that the economy can handle it, and later on the Fed's going to stop raising rates. And even if they do, that means the economy is doing well, so we got a soft landing, so equities go up. So equities are rallying on all of this, even though you may think that, hey, the bond market is selling off because of higher, stronger data, and you may think that higher rates should not be good for equities. But don't forget that in previous rate hike cycles, when we've seen increase in rate hikes, that doesn't necessarily mean it's bad for equities. Although we will see the effects, like I've been saying before, later on, because a lot of this has a lag effect. The data has a lag effect, and we see it in the economy later on. We might see it more closer to the end of the year. So with the equity markets rallying on this good news, what could we see going forward in the coming data in the next week or two, especially in the first week of March, is that we could see the data, the ISM data, probably come out stronger than better than expected. Maybe the non-farm payrolls also, same thing. We'll have to see. It's hard to tell. Well, will non-farm payrolls be as hot as the last number that we got? I think probably not, because that number does make an adjustment with last year's additions. I think this number is not going to be as hot as what we saw before, which is also going to propel the equity markets higher. So if good news is good news, bad news is still good news for the equity markets. We see here that no matter the situation, even though you may argue that this move is irrational and you don't agree with it, maybe you think that way, maybe you don't, I don't know. But even if you argue that, hey, this is going to be bad long term, the equity markets are just shaking it off, whether it's good news. And even if it's bad news, then what does that mean? That means that the Fed's going to stop raising rates. They're not going to be as aggressive. They're going to maybe cut rates, which is anyways good for the equity markets. So in both scenarios, unless something maybe is really major in breaking the economy, we could see this rally in the equity markets continue. And let's see if that's true or not. We still have to be data dependent going forward, and also with what the Fed has to say, comment by comment. Let me know your thoughts. Leave a comment below, subscribe, hit the like button and the bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.